this is the best way to invest your money.
Cost of living is costing.
The only way to beat inflation is to invest in assets that grow ahead of inflation. Stocks, shares, property, that kind of stuff.
Open your bank account. I want to see how much you've got in there.
You often always find that in the couple, one is a natural saver, one is a natural spender. Neither one is better than the other. It just depends on whether you are a healthy saver and a healthy spender.
Girl math.
So there's always opportunities, and technology and now artificial intelligence, it might close the gap if you know how to use it properly.
Why didn't you buy more? Look at you being stingy.
This is the part of love that many people don't want to talk about, but love is sacrifice. The moment you're going to marry someone, you're literally giving up your life for that person. Money is not the most important thing in the world, but it affects everything that's important. So we should be talking about it more often.
But you also have to budget in the funds for the enjoyment.
Yes.
Because
yes.
Otherwise, before you know it, the day has come and you have £20 in your account.
The future's coming, whether you like it or not.
Yeah.
It's whether you're ready for it. It's very hard out there. A lot of people are trying to figure out a way to have a level of financial independence. Yeah.
Okay. Hello, beautiful people. Welcome to another episode of the Dreams, Money, Purpose podcast. I am your host, Noma Noms. If you're new here, and if you're an oldie, welcome back, friend. Welcome back. Glad to have you here. So on this episode, I have a special friend. I haven't seen him in a hot minute. He's been booked and busy. It is the one, the only financial guru. It's Jacques Opoku.
It's Jacques Opoku, yeah.
Hi.
How you doing? You alright?
I'm really good. I'm good.
Yeah.
I'm glad to have you here.
I'm glad to be here.
I feel like you have a lot to teach us today.
Yeah.
Hopefully.
Yeah, I've got a lot to say. So.
Yeah, I like that. I like that. I mean, I saw your post the other day that you were certified for something and received a couple qualifications recently this year. Congratulations.
Yeah, thank you. So, I mean, this year, my background, 10 years ago, I graduated, finished my master's degree, did industry-specific qualifications. Mm-hmm. So, for the audience that don't know me, I work in asset management, investment management.
That's a good place to start, introducing who you are.
I'm Jacques, I work in investment management.
Yeah.
And I've been in the industry for about 11 years now.
Wow.
And so I think after 10 years, I wanted to kind of revive myself in terms of adding more qualifications to what I already have. That's what I've committed to this year. So I did something called a CFA. It stands for Chartered Financial Analyst. There's 3 levels.
Sounds fancy.
Well, it's a very rigorous exam. I had to study for, they said minimum 300 hours of studying. Yeah.
Wow.
And the exam is about 4.5 hours as well. So, yeah.
Oh, this is not child's play.
No, it's most people in finance, investment banking would know what the CFA is. It's tough. It's known to be tough. But if you get it, then it's really good. So.
Congrats. We love to hear it. I love the, self-improvement, like, okay, we've achieved this thing now, it's like a decade in, let me do a refresh.
Yeah.
Which is quite on theme with like how I feel like my mind has been and where I've been mentally, like just a refresh of like a new thing.
Absolutely. I'm in the same boat. I'm not sure when this episode will come out, but when it comes out, chances are I would have left my company.
Oh.
Yeah, I know. I didn't tell you that. Yeah.
How are you feeling about transitioning from one company to another?
Well, interestingly,
one role to another?
I'm not necessarily transferring from one company to another. I've decided to do what I call a self-sabbatical.
Oh, a self-sabbatical.
Yeah.
Oh, that's so exciting.
It's exciting. Of course, a bit nerve-wracking, of course.
Yeah.
But I've just made a decision, and it's in line with what you've spoken about already, in the sense that I just want to reset. So, again, I've been in the industry for about 10 to 11 years now. And I'm ready to just take a break. And I can't think of a better time to do it than now. I feel like my thought process behind it is, if not now, when? And so, I don't necessarily have something specific that I'm going to move into in terms of corporate. But I do run a social enterprise, which I will focus on a few passion projects.
Okay. So you're almost jumping into the empty waters. A new season. And
I'm excited. It's so exciting.
I'm excited for you. Yeah. Wow. I mean, my manager just actually left me for a sabbatical. I'm still salty, but I'm happy for him.
It's healthy. And I would encourage people to consider a sabbatical.
Is there anything that prompted you wanting to go into a sabbatical?
Yeah, just, again, wanting a reset, wanted to consider almost a parallel or horizontal shift in career. So asset management or investment management, which is what I've been doing for the 10 to 11 years, it's a specific type of finance. And it's interesting, and I've enjoyed it, and I've learned a lot. Hopefully I can share some of those things with you guys today.
Please.
And I slightly want to move a bit more into what we call private wealth, or kind of individual. Basically, who I work with, we manage the assets of institutional clients. My desk currently, our main cohort of clients are endowment funds, which are university endowments. We have charities, and we have other pension funds and stuff like that.
Okay.
And I slightly want to move more into working with retail clients, working with the everyday person, or people that have money and don't really know what to do with it. So it's very similar, but it does require a bit of a shift.
But okay, let's talk about investments. Let's talk about finance. What are some things that you've learned in your career as a, I guess, financial wealth manager?
Yeah, so my job title is investment manager.
Yeah, investment manager. What
yeah.
are some things that the everyday person can take away from some of the lessons that you've learned in your past decade?
I think some of the key things that I would, like to communicate, for example, is saving money is great. I grew up in a low socioeconomic background, poorer household. And for example, my dad gave me good advice, but I would say it was incomplete advice in the sense that he said, Jacques, work hard, go to university, do all this stuff, you get a good job, save money. And I followed, right? And I learned. But once I got into investment management, you realize that actually savings is good, but it's incomplete. And so the reason why I say that is savings and having cash is good for the short term. It gives you liquidity, which means you could use that money if you need it straight away. It can serve as something called self-insurance. So if something goes wrong, you lose your job or your car breaks down, you've got cash readily available to service that thing. However, in the long term, right? In the long term, money saved is not the best thing. And what I mean by that is its arch enemy, I always say its arch enemy of savings is something called inflation. Right?
And are we not facing that right now?
Yeah, I mean, we're going through periods of very high inflation.
Cost of living is costing.
It's
costing a penny right now.
Absolutely. And the thing is, inflation has always existed. And in fact, we need a bit of inflation for the economy to work well. So on average, the central bank, so here in the UK or in America, you've got the Fed, the Federal Reserve, they've got a task of keeping inflation between 2 to 3%. So if things are getting more expensive by 2 to 3% every year, that's pretty good. Okay. Generally, right? Okay. So we should expect inflation.
Yes.
And that's why we don't just save money in the bank, because if we're just saving money in the bank and we're not earning a rate of interest at least equal to the rate of inflation, then the value of our money is eroding. It's getting less and less and less, meaning we can't buy as many things as we used to.
Yeah.
So how do we beat inflation? We have to invest that money.
Okay. Invest your money. So I come to you, I say, Jacques, I have £10,000 to spare. I want to invest. What would your advice be?
Well, first and foremost, if you're coming to me for regulated financial advice, that's one thing. If you're coming to me for friendly advice, that's another. Okay. But the first thing I'll say as a friend or anything like that is, or even as a professional advisor, is let's actually sit down and analyze your financial life holistically. So
wait, say that again. Your financial what?
Your financial life.
Okay.
Everything holistically, right? Yeah. And what are your actual goals? There's many questions I will ask you. So one of the questions that most professionals will ask is, what is your ability and willingness to take risk?
Okay.
Right. So notice I said ability and willingness. One is objective, right, which is your ability. And often the way we measure ability, we do something called your capacity for loss, which means if you was to lose that money, can you still live your life, right? Yeah. Are you still okay? Yeah. So that's your ability to take risk. And then you've got something like your willingness to take risk, which is more to do with your attitude and how you feel about money. What you find is most financial planners will make you fill out like a questionnaire and stuff like that to try and gauge. They might be like, okay, between 1 and 7, choose your risk level. 7 being go crazy, right?
Yeah, go
or 1 being I don't want to safety, right? So that's where we'll start from, and then we'll talk about like what do you actually want to achieve with this money. And the third one, which is very important, is your time frame, right? So when I say time frame or time horizon, what I mean is, how long are you happy to keep the money locked up for? Is this money that you need in the next 18 months? Is it or 0 to 18 months, that's short term. Is this money that you need between 2 to 5 years? That's still quite short term, medium term. Or is this money that you're happy to lock up for the next 20, 30 years? All that I've just mentioned, objectives, risk tolerance, time frame, all of these questions I've asked, once I get the answer, I'll be then able to say, okay, this is the best way to invest your money, to kind of position you in the best possible way of achieving your goals,
right,
kind of thing. So if you want me to go in a bit more detail, I can as well. I'll give you some examples.
Yeah. I mean, I guess in this season, so maybe let's say the person is happy to invest the £10,000 and they're happy to lock it away for 10 years or so. Yeah. And their appetite for risk is between, so you said from 1 to 7, right? So maybe it's in the middle, let's say a 4.
Yeah.
What would your advice be? How should they be best investing their money in a way that they, is suitable for all of those categories?
All of those kind of considerations. I will then ask you, how do you want to do it, right? So one of the questions I'll ask you is, how involved do you want to be in the investment decision making?
Once a year. I don't want anything that takes too much brain work, and I want you to do the thinking for me.
Okay, very good. So unless you go to a professional, investment manager,
yes,
you can go on a platform and actually use maybe something called like a ready-made portfolio, or there are robo advisors out there like Nutmeg, Moneybox, these type of platforms.
Yeah.
So let's use Moneybox and Nutmeg as for this example of being completely passive, which is you guys do everything for me. So Nutmeg, for example, will say the same things I've asked you. Choose between 1 and 7, and what's your time frame, what you're trying to achieve, and then they then use algorithms, right? So it's a robo advisor. They use algorithms, and then they create a portfolio for you. And then all you've got to do is put that £10,000 in, and then maybe check it once a year, like you said.
Yeah.
It could be as easy as that, right? Alternatively, you might say, Jacques, I want some involvement, but I don't want too much involvement. I want to be somewhere in the middle. I want to have some influence, but I don't want to have too much influence.
Yeah.
That's when I would introduce you to the idea of things like mutual funds, index funds, ETFs, if you've heard of these terms before, where these are a mixture of assets that you can invest in. The mixture of assets does have a goal, right? I'll give an example. You said £10,000, balanced risk, 10 years. Some of these funds will have terminologies that follow them. So it could be called the Jacques Financial Adventurous Fund.
Okay.
Or the Jacques Financial Balanced Fund. Or the Jacques Financial Cautious Fund. Right? And sometimes it could even go a bit more in the middle. The Jacques Financial Moderately Adventurous Fund. Right?
Yeah.
So those names should give you a clue to say how much risk you're taking. And so if you've got 10 years, chances are you may want to go for the balanced. If you've got 20 to 30 years, you might want to go more adventurous. What I'm trying to say is the longer your time frame, the more risk you can and probably should take.
Okay.
And then the shorter your time frame, then you want to be a bit more cautious because you don't want volatility on money that you might need in the next 2 to 3 years. Does that make sense?
Yeah, that makes absolute sense. One thing I feel like with our generation, I would like to say we're a bit more adventurous and we're open to doing more than just lock your money away in a savings pot.
Yeah.
But what are some things that maybe you've seen speaking to people, maybe colleagues, maybe obviously like friends, family? Are there any differences in the way that different generations approach money in terms of savings, in terms of investments? Are we doing things that are different from maybe like the older generations that maybe we should be learning from, and things that we are doing that we shouldn't be doing that the older generation got it well or got it better than we do?
So I think the most obvious one in my industry of asset management is that younger people care more about where their money is actually being invested. Whereas the older generation cared more about just returns.
Okay.
Right.
So we're thinking about the kind of companies we're investing in and the corporations that we're backing.
Yes. So we're asking ourselves, this company that I'm investing in, are we aligned? Right. So there's a lot of, you've probably heard of the term ESG, which stands for environmental, social, and governance.
Yes.
So does this company invest, or this thing we're investing in, do they do animal testing, right? Because I love pets, for example, say,
Yes.
right? Or this company, they manufacture weapons.
Yeah.
I don't want to be invested in that.
Yeah.
So there's a lot
Or
of ethical
harming the environment and things
The
like
biggest
that.
one, I think, is climate change.
Yeah.
And paying attention to carbon emissions, etc. So because we're the young ones, right? We're the ones who
course, we have to
and
think
our
about
children
that
and stuff
stuff,
like
yeah.
that. Absolutely. So the most obvious one is the young people care more specifically about where their money is actually being invested.
I love that. I love
Yeah.
that. So what are some maybe mistakes that we are making as a generation that the older generation were not making with their money?
Yeah. So I think there's pros and cons of technological change.
Yeah.
What I'm seeing is, and what's obvious is that technology allows us to invest cheaply and easily, which is good, generally speaking, right?
Easy access.
Easy access. Most platforms now allow you to invest at a very cheap cost as well. Historically, the charges for you to invest in a company was quite intense. Without the technology, in order for you to know if the stocks you've invested in were doing well, you normally get the newspaper, like the Wall Street Journal, and you have to check to see what happened just that day. So you only get one pricing point, right? You only what I mean by that is you only see that day, at some point in that day, what was the price.
Yeah.
Today, we've all got this thing called a phone, a smartphone, right? However, because we have so much access to the platforms, we can literally check our phone every 2 minutes to see how our
Your
assets
stock
are
is
doing.
your assets are doing, your investment is doing.
And that does not encourage good investor behavior.
So then is it causing decision fatigue, or is it causing people to be almost scared a little bit because you're seeing that little chart go up and down the whole entire day?
Yeah.
So now you're like, what is going on?
Yeah.
Am I making the right decision? Am I going to lose my money? So instead of making a decision, I'm not going to make a decision at all.
It's actually the opposite. People are making too many decisions.
Ah,
Right?
okay.
So essentially, they're looking at their portfolios or stocks and it's going up and down. It's like, oh my gosh, it's going down. I probably want to sell it before it goes down further. Whereas investing's always been a long-term phenomenon, right? You're not supposed to check your portfolio every day, let alone every hour. Some people every half an hour. Right. And so what happens is we're human beings. We in finance, we have something called the animal spirits, right? The animal spirits, and it governs how even the stock market behaves.
Okay.
That's why the stock market is quite volatile. It's the animal spirits. What are these animal spirits? The two most obvious animal spirits are greed and fear. Right? So greed causes us to do things that are quite irrational, and same way fear causes us to do things that are quite irrational. And so when the stock prices are going down, we get scared and we sell the stocks at a cheaper price, right? So we could have bought it for $100 per share. It's gone down to 80, and we're so scared and we're panicking. So what if it goes down to 50 and it's 40, and then what if it goes down to 0 and the company goes bankrupt?
Yeah.
Right? And then
Almost
you sell.
like what happened, was it 2 months ago, a month ago, with when Trump was doing what Trump does, and
Trump was being Trump. He
Yeah.
announced these tariffs that caused mayhem in the stock market.
Yeah.
It was one of the biggest drops in a single day.
Chaos.
Absolute chaos, right?
Was it maybe the biggest drop since, was it 2020, 2019?
Yeah. I think yes, since March, since the
Pandemic.
the pandemic. Absolutely, yes. And so, the way the stock market works, and this is where education comes in, it's a marketplace. And because it's a marketplace, all the people in the market are trying to bid for the price of these assets. And so when everybody gets scared and everybody wants to sell, the price has to come down. But you might be selling a business or an asset. And by the way, stocks are businesses, really and truly. Nothing's changed in that business. It's just an announcement that might take place, might not, right?
And then suddenly everybody's like, let me grab my stuff, I'm going.
Do you know what I mean? Yeah. Everybody panics. Everybody panics and wants to sell. And so, if you're, if you're not very strategic and you haven't been taught that actually during these times, you probably want to take a breather, maybe sit it out, don't do anything at all.
Yeah.
You might have sold something at a loss. And guess what? At the point of shooting this episode today, the stock market has recovered and gone beyond that point, right? So all you had to do is just wait.
It's just wait.
Right? So the animal spirits is what causes a lot of people to make irrational financial decisions. And there are many emotional biases and cognitive errors that causes us to make very weird decisions when it comes to finances. And so being able to access your stock portfolio on your phone again, it's got its positives because you can do things very quickly, but it causes the young person to make too many decisions
sometimes when we should be sitting it out.
Yeah.
Are there any other maybe mistakes or financial habits that we have as a generation that maybe the older generation just didn't do? Obviously because of like different, no, let me rephrase that. Is there a difference in the way that we're spending our money and our attitudes to money in comparison to the older generations?
Absolutely. I would say so. And I'll give you some examples. Again, a lot of this stuff comes down to access. I'll give you a very obvious example. Have you noticed that there are more Range Rovers on the street nowadays than when you was younger, right? Yeah. When you was younger, if you saw a Range Rover, that person driving it was a rich person.
Yeah.
Right? Nowadays, the person in your class or your colleague who you know is not earning that much still can drive a Range Rover.
Yeah.
And that's because we've got more access to credit, right? And so we've always really been a debt economy, but we rely on debt a lot, all right? And it's easy finance nowadays. You can finance anything. You know, we've got companies like Klarna, which is buy now, pay later, which wasn't so prevalent back then in terms of people using credit and stuff like that. So because we have so much easy access to what we think is our money, we tend to spend a bit more, sometimes irresponsibly. Yeah. The flip side is we're also more knowledgeable because of social media and stuff like that. So one of the ways I think we're spending better is the fact that we spend better on experiences, right? Because we notice that actually experiences are what's important. Those memories that stay with you is a good way to spend money. So there are people within the economy that are doing one thing, some are doing the other. It depends on where you stand.
So we're spending on experiences, and I love that. But potentially with some of the bigger purchases, especially with buying homes, and a lot of people, you know, we want to buy homes, but in this economy, it can sometimes feel as if it's such a faraway goal, right? Yeah. So then the alternative is, it feels as if this goal of buying a home is so far away from me. Let me buy what's nearest to me and what I can afford, which is the experience. Mm-hmm. So I can do a £500, £600, £1,000 trip to Bali, to Greece, to Miami, but buying that £350,000 home feels like 10 million miles away
eternity
from me.
Away, yeah.
So is it that maybe that's got to do with the way we're spending our money instead?
I think so. I do think, again, I just think people are more exposed to different things. And so the opportunity to spend money is much more vast. So it can be that you want to spend on experiences, the Range Rover example I gave. And yes, we are absolutely living in a very tough economic backdrop, economic environment, where the cost of everything really is high. And quite unfortunately, you know, when we go back to talk about the differences between our generation and the generations before us, predominantly in developed economies like the UK, the US, and other parts of the Western world, etc., is, for example, property prices were so much cheaper relatively compared to our generation. So I can't remember the exact statistics, but I think the average house price 60 years ago, 50 years ago was maybe like twice or three times the average person's salary or wages. Whereas now, I think it was four times. Yes, it was four times the average person's salary. So if you earned £20,000, the average house price was £80,000. Now it's 8 times, so it's doubled, right? So the same £20,000 now, it will be 160. And so that shows how difficult it is for the average person to even save a deposit. Firstly, to even save a deposit to buy the home, but secondly, to even get the mortgage, because remember, you only get lent around 4.5% times your actual income. So actually, if the average house price is 8 times, then how do we even get the mortgage?
Yeah.
The maths is not mathsing.
Something's not, yes.
Something's not right.
Maths is not adding up for sure.
So it's very difficult. And absolutely, some people have I wouldn't say completely giving up on the idea, but it's you know, if it's going to take you eternity to save for a property, you might as well enjoy your money now.
Yeah.
That's how some people think.
It's like, let me enjoy it whilst I wait, or whilst I still work to the point where I can afford to buy that property. What are some other maybe money traps that we're accidentally getting ourselves into without realizing? And I think especially because, you know, cost of living crisis, there can be a tendency or the temptation to, you know, resort to the Klarna and the buy now, pay later way of life.
Yeah.
You know, as we said, I think it's something that we're accustomed to as a generation, but whereas our parents preferred to do the, I'm going to do something, I'm going to buy something when I have the cash.
Yeah. And you mentioned a very interesting term just then, cash. Right, back in the days we spent a bit more cash. Nowadays it's
Card, yeah.
Right, and that again changes our behavior because
Apple
we don't
Pay.
feel the pain of the money leaving our account or our hands. So when you pay for things with cash, then you'll be like, okay, I'm actually spending quite a bit of money here. But if I'm paying by, and this isn't even debt, if I'm just paying by cash bar rather than paying it physical cash, but I'm just tapping, it feels different.
Yeah.
And that can again encourage, I don't want to say reckless, but sometimes it can be a bit reckless in terms of how much we tap.
And I think your mind doesn't always register that money is
No.
leaving your account
Until you check your
every single
statement.
time you tap in.
Yeah.
And I think, which is so interesting, because I think sometimes people are like, well, as long as I'm tapping away and it's not declining, I'm fine.
Yeah.
Up until they're like, okay, maybe now I need to check. It's, you know, it's getting towards maybe like the third week of the month, and it's like, okay, maybe I should start checking the bank account.
Or maybe
to see how much
when
I
you
have.
tap and it doesn't work.
You know, then you hit
Then you
decline.
know.
You're like, oh, maybe I should actually
yeah.
have a look and see like what's going on in the account.
I do want to answer your question about what other things I'm seeing. And I think this is really important, which is because it's very hard out there. And I appreciate that it's very difficult out there. A lot of people are trying to figure out a way to catch up and a way to actually have a level of financial independence. And there are ways to do that. But unfortunately, sometimes what people are doing is they're trying to find a quick way of doing it. And what you're finding online is there are many
Get rich quick schemes.
quick schemes that will lure you in. Really, they have very articulate, strategic ways of hitting your emotions and luring you in into a some sort of scheme that you shouldn't really be a part of, but you want to because you believe that this is your way out. There's no way your 9 to 5, again the average wage that we just described, is gonna afford you the ability to buy a home, right? And so you need to find something else. And if someone says, hey, come and join this pyramid scheme, they won't say it like that, but they will say, hey, come and join passive income, use all these buzzwords. And you might not know that you're actually joining a pyramid scheme. You will soon find out.
Yeah.
But then by that time, that person has taken your
It's like,
fees.
I think the older you get, you now look at the younger generation like, we've got it tough. Now, what about the generation, I guess, Gen Z and is it Gen Alpha to come after us? What's going to be their situation? You know? So, I'm very worried for them. But then again, because financial times change, right?
Yes,
It's almost a merry-go-round. So, by the time that they come around, it could be a completely different situation.
The way I see it is, and I'm a Christian, so I believe in God, and I think God has created a world where there will always be opportunity. It's about spotting the opportunities. And what you find, one of the things I've found in my adulthood is everything has two sides. Everything has two sides. Pros, cons. There's not one thing I've come across that hasn't got the other side. Even if you don't pay attention to it, it exists. And so the other side to all of this is there is actually opportunity out there, right? This is a time where look what we're doing. Like I think we met online, and now we're having adult conversations in the studio, right? This is fantastic. It's 60 years ago. This would have been something that would have been very hard to do. So there's always opportunities, and technology and efficiency and now artificial intelligence comes with its scary things, I must say, but it might close the gap if you know how to use it properly. And so I think the key thing is always spotting the opportunity.
What are some practices, particularly at this time where, you know, there's talks of a recession? What are some practices that we can start putting into place now with our finances, building wealth even, that we can start putting into place to ensure that in the case of a recession, that we are recession proof
Yeah.
or we are in a safer space.
Yeah, and actually, what I would even add to that is actually take advantage of recessions, because recessions make a lot of millionaires.
Say that again. Say that again
Recessions
louder.
do make a lot of millionaires, and I'll explain why, using just one example, even in the stock market and stuff like that. I think what's really important as people, when we are managing our finances, we need to understand that there is something called business cycles, there is something called credit cycles, but things move in cycles. Again, it's just like life cycles, right? We have boom, we have bust, we have peak, we have trough, we have expansion, we've got contraction. The economy is always going up and down, down and up. That's always going to be the case. And so we have to understand that. Why do I say that? It means when things are going great, know that at some point it's not going to be great anymore. And also, when things are pretty low and pretty crap, it's not going to last forever. There will be a good time again. And we can use that to our advantage, this piece of knowledge, to say, and there's many Bible scriptures and Proverbs that talk about, look to the ant you sluggard, for he doesn't even know, he doesn't even have a leader, but he knows when to gather his stuff for the winter, right? So winter's coming.
Time for everything. There's a time for everything.
Right? So I said that to say, in terms of practicalities, like I said earlier when we were talking about saving and investing, save for self-insurance. Cash is our first defense mechanism. And so what is really important, and most financial planners will tell you, have at least 3 to 6 months worth of your monthly outgoings saved in just cash, right? So if you spend £2,000 a month, you need to have at least 6,000, which is the 3 months, or 6 times 2 is 12, so 12,000 if you want to do the 6 months. 3 to 6 months, it depends. You get to choose which one you want. It depends on how easy it might be for you to get a new job, for example, and stuff like that. That's your first self-insurance. And then the second one is you always think long-term as well, right? So when we talk about long-term, we're talking about, I'm in my 30s now. At some point in my life, I want to retire. I want to be able to invest. Remember I said earlier, the biggest risk for your money long-term is inflation, right? Because the longer it goes on, the more it erodes the value of your money. And I can teach you a mathematical formula that I came across recently, which really highlighted this. But there's a very popular Bible story that I think I teach all the time when I speak at churches. So I speak at a lot of churches.
Yeah.
And it's in Matthew chapter 25. It's about the story of the talents. And this man is going away for a long time. He calls his servants. He gives them money, right?
Yeah.
They're called talents, but people, it's actually money. And he comes back. 2 of his servants have doubled the money, and one of them is put under the ground. And then he's very angry at the one who put it under the ground. He casts him aside, whatever. Why was that story so profound? And why is it that when I got older and I understood economic systems, I really understood why he was so angry? Because it says in the Bible that person was away for a very long time. Remember earlier, I said inflation is usually about 2 to 3%.
Yeah.
It's been about 3.5% on average for the past 100 years. There's something called a rule of 72. It's quick math. Rule of 72. Okay. What that means is, whatever rate you're getting, just divide that number into 72. And you will learn about something called halves or doubles. I will explain. I'll use an example. So if you take out debt today, have you noticed some people take out debt and by the time they know it, the debt's doubled? It's because there was an interest rate, and that interest rate, because they didn't pay it back, it compounded and then it doubled. Rule of 72. You can also do halves. Why am I saying this? 72 divided by 3, because 3% is what I'm using it for the inflation, will tell you how long it's going to take for your money to lose half its value. 72 divided by the inflation rate will tell you how long it's going to take for you to lose half the value of your money. So if right now, if you've got £100,000, you've just inherited it, or you've won a lottery, and you just put it under this chair, and then in 24 years, because I did 72 divided by 3, 24 years, you picked up that £100,000, it can only buy half the things that it used to.
Wow.
So I just wanted to throw that out there. It's always a good thing to understand.
That's very sobering.
so
don't very sobering.
Always think long term. Always think long term. In the short term, have your self-insurance, cash, emergency fund. Aside from the emergency fund, you should also have cash for any near-term purchases that you're about to do, right? So if you are planning to buy a house in the next 3 years, or you're planning to get married, or have a big wedding or something like that within the next 2 to 3 years, you should have cash for that. And then the last part I want to say is, as an investor, we should always be investing. That's why I give the long-term example, because you're trying to keep inflation, at least for the long term. In your investment portfolio, you can be very strategic. You can say, right now, we are definitely at the peak, right? Things have been flying for a very long time. I now want to take some of my profits and keep it as cash. And that cash doesn't hit your bank account. You keep it in the portfolio, right? So the terminology we use is dry powder. Why do we call it dry powder? I don't really know. But all it means is it's almost like your opportunity money, right? You just keep it as cash, because what happens after the peaks? Troughs happen.
So when the troughs happen, you use that cash to invest.
It's showtime, right? So the property that used to cost 100 grand during the peak, now during a trough, it now costs 70 grand. So now you go at a 30% discount. It's your time to shine. You go and buy those assets.
Okay.
Same thing about the stock market. Most deep recessions, like we did in 2008, stock market dropped by 60%.
Huh?
60.
Really?
Yeah. Same as the Great Depression, 1929 to 1933.
I mean, to be fair, 2008,
we
we were young. Yeah. So why would I have known that?
Right?
60%?
Yeah. The pandemic, it dropped by about 30%. So these are all discounts if you've got the cash.
Girl math.
Right? So hindsight is always perfect. So, earlier I was talking about biases. We've got something called hindsight bias. Right? Because hindsight says we should have bought more. But let's be honest, we didn't know what that guy was going to do.
Yeah.
We don't know what he's up to.
Yeah.
Thing is, we're emotional creatures. Again, animal spirits, fear.
Yeah.
So we can say right now in this conversation that the next market crash that happens,
we're gonna go hard.
We're gonna go hard. When it happens, I guarantee you we're gonna be like,
Yeah.
Is it gonna go lower? Or
Yeah,
should we wait?
yeah.
Should we just double in it and that kind of stuff? So
actually, you're speaking about the animal spirit thing.
Yeah.
Something I've recently discovered, and as I was prepping for this, was like the different personalities, or the different finance personalities, or like wealth personalities, or spending personalities. Talk to me about that, and like how that determines the way that people spend, the way that people view money, the way that people invest, or even just all of that.
Let's talk about. So I mean, look, we all have personality traits, and there are different studies, and they try to categorize people into different categories: savers, investors.
Actually, I think I've got the list here.
Yeah. So talk me through the list.
So we have the saver. So let me just start again. So we have different money personality traits.
Right.
One of these is the saver, the investor, the big spender, the debtors, the shopper, and I think there was another one which is missed out.
Just a whole bunch of people that spend money. Yeah.
Which do you recognize any of these as being you? Which one do you sort of?
Ooh.
Which one would you categorize yourself in?
So I am most definitely a saver. It's important that as I say this, that if there's anyone there that's a saver, you have to ask why. So I was a saver. And by the way, all the things you've mentioned, none of it's good, none of it's bad.
Yeah.
Right? None of it's good, none of it's bad. Sometimes I do premarital financial counseling. And one of the things I say...
I didn't know that's a thing. I mean, I knew about premarital counseling, but premarital financial counseling. I just thought maybe, you can talk about it in the main...
No, so I don't even know if it's an actual thing, but I've created it as a thing. In a sense that...
It is now.
It should, because, I mean, I've done counseling before I got married.
Yeah.
And we did a financial side, and I was like, you know what? I think people need to do more premarital financial counseling, because money is, for a long time, was number one reason why people actually don't last in their relationships and in their marriages. And one of the things I say is, you often always find that in the couple, one is a natural saver, one is a natural spender. Neither one is better than the other. It just depends on whether you are a healthy saver and a healthy spender, right? Because someone might say, okay, when I hear natural saver and natural spenders have to be better. Because natural spenders, that's giving me irresponsible vibes, right?
Yeah.
But actually, as someone who grew up in a low socioeconomic background, saving was a form of survival, right?
Protection.
And it was birthed out of scarcity.
Yeah.
Right? So it's a scarcity mindset. It's a lack mindset. Which is not always positive. It's actually more negative than it is positive, right? And it can force you to sometimes oversave, not take enough risk in your life, which is why I'm so happy that I'm taking this risk we was talking about when we first started.
Yeah.
Because of fear, because you grew up poor and you don't ever want to be poor again. So you oversave.
Yeah.
You don't actually, you might have a lot of cash in your bank account, but you're not living a fruitful, fulfilling life, because the money's just in the bank account, sitting there, and you're not even paying for these experiences that
frugal
you should
Fran.
Do you know what I mean?
Yeah.
So
Now you're giving me. Have you seen that? There's like a TV show. I don't know if you've seen it, right? Or like clips online of this TV show about like people who are very frugal. And like there was this particular man on the show where like he doesn't have sofas in his house. I think he sleeps on the floor.
Whoa.
There was like one family where like they they reuse the bath water. So
don't do this to me. No.
so
What?
if the mom has a bath, the dad will come and use
no.
the same water to have a bath.
No.
And the children, I swear.
See, that's not frugality. I think
swear.
that's madness, personally.
Like, yeah. And then, like, let's say they would, like, boil pasta. Like, cooking that very same water that they use. They'll go and use it to cook something else.
That's
I'm like,
disgusting. That's disgusting.
please.
That is an extreme.
Life
yeah,
is not
yeah.
that serious.
No, it's
Enjoy.
never that deep. It's never that
It's
deep.
never that deep.
But that's extreme scarcity.
Yeah.
Right? That's not, they might hide under frugality. Frugality is not supposed to be stinginess or starving yourself. That's not frugality. Frugality is a good thing. You can be frugal. You can be intentional with how you want to spend your money and say,
Absolutely.
actually, I want to save more than I spend. That's fine. That's why I said earlier, it depends on how healthy you are. So that's one example. And I always tell people, again, in a premarital, that one of you is a natural saver. Chances are the other person is the opposite, which is a natural spender. Again, natural spenders is a bit more self-explanatory. If you're spending well and good on yourself, experiences, looking after yourself, dressing well and that kind of stuff, that's good. But if you spend everything that comes in, then you're irresponsible, right? And
let's
so
rein it in a little bit, bring it back.
do you understand? And so what happens a lot of the time with married couples or people in relationships is if they're both unhealthy, it's an absolute disaster because they will end up resenting each other, right? You're spending all the money. You're not spending enough, right? So it just becomes a disaster. If you're both healthy, then great. Fantastic, right? I think me and my wife are both at healthy levels, right?
Yeah.
So there's times, but you can drift sometimes and overdo it a bit because as an investor, I just want to save a bit more cash and buy that stock.
Yeah.
Well, Jacques, want to go on at least couple holidays a year, then I'll be like, oh, okay, whatever. Go for the holidays. Like I enjoy myself more, right? so if you're both healthy, you can help each other out.
Balance.
But it's important to understand that chances are the other person is actually different from you, and you should let that complement you rather than you rubbing against each other the wrong way.
Yeah.
So we all have money personalities. It's just about understanding which one is you, why, and then whether you are at the healthy level or not.
Yeah, I mean, I feel like I am a natural saver, and it's so interesting because, like, even when I was young, and I'm talking about maybe like year 3, my mom would like give me like like money. Okay, go and buy sweets after school or like a little snack after school, whatever. And like I would save some of it, and I remember like I don't know. She must have been talking about money, and I think she just didn't have cash on her for whatever reason. And I was like, oh, like I'll give you mine. And for like someone who's in year 3, I don't know how old you are in year 3.
I think it's like 6, yeah, maybe 6.
6, maybe 7, 8.
Yeah, 6, 7, 8, yeah.
I had I gave her like a bunch of money.
That
And
you had
she
saved.
was like, that I had saved. And she was like, where did you get? I was like, you gave it to me.
Yeah.
And I think that's just sort of carried on. And I think it's so interesting because like, I think, as you were saying, money really does link to our background, our upbringing, and our emotions.
Yes.
And then I went through a season where it was like YOLO.
Yes.
And
Yes. I want to speak on that
that
for a
was
moment.
birthed from not a good place, from a place of like mentally, emotionally, I'm not in a good place.
Yes,
So
yes.
I'm going to spend this money because in whichever way, because it's the only sort of like thing that's bringing me joy right now. So
Retail therapy. That's what they call
retail
it.
therapy.
Things like
So
that,
YOLO.
Yeah.
If
Yeah,
it's
I've been there.
food, I'm going to buy food. I'm going to get cute. I'm going to get a dress. I'm going to buy this. I'm going to get my hair done. I'm going to, all of these like emotionally soothing myself using money, even though I knew I shouldn't have been using that money
But you know what it is?
in that way.
This actually happens a lot to natural savers. When you oversave for such a prolonged period of time and something happens, it could be a trigger, like you said, just not in the right space mentally.
Yeah.
You start to resent yourself, and it's like, actually, you literally YOLO. Like,
Yeah.
I'm going to do the opposite of what I've been doing and what's felt natural to me for a while. Right. And I've been there. You go wild. For me, it's like, actually, I've got this cash now. I'm just going to go buy a car. I remember when I was 26, I just got £15,000 to buy a car cash. Looking back, I was like, yeah, that was an emotional decision. That was a very emotional. For someone who's a saver, that was quite wild, right?
Yeah.
And that's what happens when you are a natural saver sometimes and you don't do enough to spend. When you do go through whatever is a trigger, you then overdo it. Which is why I say for both, whatever money personality you've just mentioned there, whether savers, debtors, whatever, what's really important, investor, even investors, you can invest too much, take excessive risk, right? What's really important is you find the best mix of all these things. And one of the best ways to do it is to try and take the emotions out of the decision making. Because no matter what, no matter how healthy you become, no matter how healthy I become as a saver, I would never feel comfortable with too much debt, and I would never feel good when I'm taking out debt. But debt can be good, right? If you use it as leverage for an investment, for example. So one of the things we can do is automation. When it comes to budgeting, money management, work on your automation. Set up systems.
So an automated budget.
Automated budget. So when you get paid, money naturally moves from your checking account or your debit account to, let's say, a savings account if you're trying to build your emergency fund. Money moves directly, automatically into your investment account. For those that are natural spenders and they don't want to think about saving, they've done it automatically. So they have no guilt when they're spending because they've taken care of their investment needs.
Yeah.
Similarly,
so that, for the rest of the month, I don't have to, whatever I have remaining in my account is for enjoyment, is for food, is for YOLO, is for maybe a cheeky random trip on a weekend. Because I've already done the savings, I've already paid my bills, I've already paid any debt that I've got, I've already, done the investment.
Taking care of all that stuff. And for myself, this is something I had to do as a natural saver, is I then created a different account and I call it my vibes account, right?
I like that.
Vibes. It's pure vibes. And so I open up a separate account, and every month I move money automatically into that account. And so that's my account that if I want to just go a bit wild on food, I'm a foodie, and just tap, I can go wild, right? Because that is my fun account. But I have a rule, which is I can't let any money sit in that account for more than a month.
Oh, okay.
I have to spend it.
Okay, so it's like this money is allocated for enjoyment.
It's for enjoyment.
And this enjoyment, I must enjoy it in the month of May or June.
I have to. And if somehow it rolls into the next month, I can go and buy myself some trainers or something.
I love that.
Do you know what I mean? I just have to spend it. And that helps me to, again, it's all about allocation.
Do you know what? To be fair, I was talking to someone the other day about with adulting, you have to even schedule in fun. Yes. Like you have to schedule in fun, you have to schedule in to see your friends, sometimes even 2 months in advance, but you also have to budget in the funds for the enjoyment.
Yes.
Because otherwise, before you know it, the day has come and you have £20 in your account, or you have £100 for an activity that costs £200. So it's like you just have to really just think about every single thing and every single penny and just budget it all. Yeah. But then again, even with budgeting it all, you feel more comfortable because you're like, oh, I know I got it. Like I've got a girl's trip, but I already put aside £50 or I already put aside £1,000, however much is your budget, and you got that taken care of. Now I want to go back to something you mentioned about financial, what did you call it? Financial counseling.
Premarital financial counseling.
I want to talk about the concept of marriage as a business deal. What do you think about that? Because
marriage as a business deal,
or as marriage as a business, because that is a concept that has been sort of floating on the internet streets. Well, what are your thoughts on that idea versus marriage for love and for the feels and rainbows and butterflies?
Yeah, happy ever after.
Yeah, I mean, I feel like you may be the perfect person to speak about this because
I'm recently married as well.
Yeah, right? You're recently married. You've in the financial sector, so you know all of those things. Yeah.
So can I be honest? Look, I think historically, history matters and culture and tradition. We must understand that historically things were done in a certain way for a reason. So even when you go back to the agriculture age, a lot of people would get married and have lots of children to work a farm, right? It was a survival. It's survival to get married and have children, right? To work the farm because that's the labor force, right? So sometimes things happen historically for a reason that we don't remember, and sometimes it just carries on throughout the years. And as things are changing and those issues no longer exist, some people still hold on to some of these ideologies without actually understanding why it existed in the first place, right? So there's that. Now, in terms of my personal view, I think the key thing to understand is that marriage should be done not as a business transaction. It should be done for love. However, we must define and understand what love actually is. I think when people talk about marriage for love, they think they're marrying from romance. Romance is not love. In fact, it's just one of the extensions of love, an act of love, right? But love is much, much bigger than what people think. And that's why when people say, oh, don't marry for love, it's because they don't understand what love is, kind of thing. And then the second one is, when it comes to business, you can't be naive to understand that the moment you are getting married, you're becoming one with someone, right? Everything is joined. Even if you think you're going to be independent, the state sees you as one. The state sees you. So you try and get divorced, it's 50-50.
Isn't that so interesting how, like, even as the word says, like, to become one as a spiritual concept, but now even that to become one is physical, live. The law, the state sees you as one.
So you're not independent, you're interdependent. That's the bottom line. Even if you try and, within your own marriage, you try to do things individually, when it really comes down to it, you're really one entity. I say that to say you must then consider who you're marrying. So if you're marrying someone who has a bad money mindset, unhealthy money mindset, has lots of debt, for example, these are discussions you must have before you get married, right? And that could be a deal breaker. I don't think it should be, right? Because we all make mistakes. For me, it's all about what is your mindset, what happens, what can we do going forward. All of that's important. But it can be a deal breaker because it might highlight that this person might just be an irresponsible person, right? So it opens the gates for communication and understanding. So is marriage, so you marry for love. Again, I don't want to preach too much today, but the Bible says in John 3:16, for God so loved the world, he gave his only begotten son, right? And we normally say that in Sunday school and John 3:16, but it shows us what love actually is, right? And this is the part of love that many people don't want to talk about. But love is sacrifice. Love, the moment you're going to marry someone, you're literally giving up your life for that person, kind of thing. And so, and I think we're living in a time where we are all quite selfish. We all want to be independent. We don't really want to give up our life for someone else.
No, we want to serve us and do what is suitable for me, and it serves me, and
which then makes it transactional.
I'm letting go of that thing because it doesn't serve me how I want it to serve me. What advice do you have for couples? Maybe they're not married yet, they're living together, but they want to have that conversation about finances, and it can be very awkward. And and I think it's the British way of like being very secret, reserved and somewhat secretive about finances. You don't really talk about finances publicly. So how do you encourage, or how do you tell people to start opening that conversation and start having that conversation in an honest way?
Well, it depends where they are in their relationship, right?
So maybe they've not spoken about finances.
But they're living together already.
No, not yet.
That's what they say. You guys have gone above. To be honest with you, you can actually talk about finance from the moment you meet someone now. I'm not saying on the first date, what's your credit score? No, don't do that. That might turn someone off. But
how much do you earn?
How much do you earn? How much do you have in savings? Do you have any debt? No.
I mean, to be fair, sometimes I wish we could do that. Okay, here's my proposal. Do you guys want to hear it?
Let me hear it.
So I heard that in particular communities, and I heard this from someone who is in the Asian community, like Southeast Asian community, and she said they have this thing called marriage CVs.
Okay.
Where it's literally a CV where it just states like who you are, a little bit about educational background, family background, just a bit about who you are, and essentially that CV is kind of given around to people, or like proposed to other prospects. Essentially, the families of prospects, and then obviously they can respond and say, "Oh,
I'm interested in this.
I'm interested. I would love to know more." To be fair, I feel
isn't
like
that what online dating kind of is?
Basically, and I feel like it could.
It
could solve some of our issues in our community.
Do you know what? I don't disagree. Right, I actually don't disagree. I mean, like most things in this world, when you introduce a concept, people will be like, "No, that's too much," or whatever. But all it takes for a few people to do it, you realize actually this is a very good way to sieve out who you don't wasting your time going on a date, spending money that you may not want to spend, all that kind of stuff, spending time with someone you don't want to spend time,
that part,
and that kind of stuff. So I'm not even against it. I think really and truly, if people were a bit more transparent, things would be so much easier
from the get-go.
But it doesn't have to be in the first day. Absolutely not. And it also depends on what you're talking about.
So how can people start to have those conversations though in a way that is comfortable for both parties? And because I think sometimes the issue we're talking about finance is that people feel people feel judged, or maybe there's shame if someone has debts, and it's vulnerable because it exposes a part of you that typically you wouldn't necessarily expose. So how do we begin to have those conversations?
It's more difficult when your financial situation is tougher. So actually, so the solution for that person might be different from someone who's quite confident in their finances. If you're quite confident in your finances, chances are you can literally just start talking about it. And just start talking about your ideas. Or one of the things that a lot of men do is to talk about things that their vision for the future. I want to buy these properties and that kind of stuff. That opens the conversation up. Like, oh, so you want to buy this property? Well, how much do you even earn? Now, some people have the communication skill of dampening down serious conversations.
So maybe just set the tone. Set the tone and don't make it like a serious sit-down conversation. Like, okay, open your bank account. I want to see how much you've got in there. Or
you only do that if you've not had a money conversation and now you are at that stage where proposal is about to take place. Then you want to have the serious conversation. And come on, we're grown-ups. We must sometimes have uncomfortable conversations.
Absolutely. And I mean, to be honest, if we're about to have a whole life together, then we need to have that conversation. And
if you love the person, then
it's like, let's talk.
Yeah, if you love this might be the opportunity to realize that maybe you don't want to be with this person anymore, in the sense that if the person judges you and makes you feel pretty crap about yourself, why would you want to marry this person? So it's an opportunity. Money is a very sensitive topic, but it serves a purpose because it's a medium of exchange. Money is not the most important thing in the world, but it affects everything that's important. So we should be talking about it more often, which is why I have even mentioned it. I run a social enterprise where we go into schools, youth clubs, churches, we work with football clubs, basically any entity that has young people between the ages of 11 to 21 and from underrepresented backgrounds. We teach them about money from a very young age. So we teach them about credit scores. We teach them to avoid being used as what we call money mules, which is where like scammers will use them and stuff like that. And fraud and stuff like that. We teach them about the idea behind investing and why it's even a thing. We teach them about financial crime. We teach them about everything that we wish we knew when we were between the ages of 11 to 21, because nobody was teaching us. And I think if we could start early, then money conversations could be much more simpler rather than it be so intense. Oh my God, that person's about to ask me how much I earn and I'm going to feel little about myself. We spoke about this in the last episode that we did from 4 years ago now, and we spoke about black tax, which I will put the definition of black tax on the screen. But I want to just continue on that conversation a little bit and discuss how, we've acknowledged that it happens. And in recent conversations with other people, I realized how much it can be debilitating for some, in that it restrains how far you can go, how quickly you can get ahead financially and with some of your financial goals or life goals that you may have. But is there a way for someone who may be out there, like, I have responsibilities, I'm taking care of grandma back home, or I've got an uncle that I'm taking care of financially over here, or all of those different things? What can people do to make sure that they're not getting left behind as a reason or because of black tax and the responsibilities that they have over other people? So I do think it's a case-by-case thing, because everyone's situation will look slightly different. Right? And I think with the black tax, when it becomes straining, when it starts to drain you, then a conversation has to be had. And you yourself have to have a conversation with yourself to say, this tax that I'm paying, am I paying it to better someone's life? Can that person look after themselves? Or am I an enabler, right? Because sometimes we think we're helping, but we're actually enabling. So you have to do that analysis, right? Because, historically when someone asks me about the black tax, and I know people's viewpoints and it's quite negative, I used to say to people, well, I feel quite honored to be in a position to actually look after my parents financially, right? But my situation, that's why I said it's a case by case situation. But that's because I've been financially okay, right? And the percentage that I support my parents with is it doesn't drain me from moving forward in my life, right? So it's a case by case situation. Nevertheless, even in my situation, sometimes there can be hidden resentment. Sometimes working in asset management, predominantly in the front office, I work with people whose parents give to them, right? So I said to them just a couple of weeks ago, I said, oh, so you didn't have to take out student loan, or your parents paid for uni. That's fantastic. Your parents bought your first car for you. That's really nice.
Must be
Yeah.
nice.
Your parents gave you a deposit for your first home.
Oh, you inherited 100,000 from your grandmother.
Right. So it's a different. I've understood that my journey is different.
Yeah, absolutely. I think sometimes you just have to embrace. God has given me a different life, and that is okay.
And that's okay.
That's okay.
However, I just want to give some tips here, because one of the things I have done in my situation was this. I don't know if I mentioned it in the episode that we done, but I recognized early. I'm quite a futuristic thinker, sometimes to a fault, but I recognize that my parents are going to retire in the next 10 years. And chances are they may not have the resources to fund their retirement. So what can I do to help? I'm not going to wait for them to reach retirement. And once they're there...
And then start planning.
Start panic. And then start funding some of their retirement out of my active income. So what have I done? And I hope they're not watching this episode, because sometimes when they know, they ask for it straight away. What have I done is I within my portfolio of investments, I've invested in a specific asset, an index fund or a mutual fund, and I'm growing that asset over the next decade. It's a nice long time, so that by the time they need it, I can pull out from the profits of that investment. So it's not coming out of my active income where I'm working and then paying them. Do you get what I'm saying?
So is it sort of like a dividend?
It could be a dividend, dividend, so you get two types of returns from investments. You can get the dividend or the interest, but you can also, the asset can grow in value as well.
Yeah.
So if I put in 5,000 now, by then it might be 15,000 or 10,000. That's a growth, but also it can spit out dividends, and I can use those dividends to fund wherever they need to fund, and not feel like I'm losing money.
Yeah.
Do you get what I'm saying? It's like I've got a tree already, I'm just giving them the fruit, but the tree exists. That's a strategy that people can adopt if their parents are going to retire in the next 10 to 15 years. You can start creating a portfolio, not by yourself. If you've got siblings as well, speak to them. They can contribute, and chances are you don't tell them, because if you tell them, their attitude may change, and it actually may be self-sabotage or sabotage the whole thing.
Yeah.
So this is a very simple example that I've given you that I've done. I think can help.
It's so simple, but like my mind is like light bulb. Honestly, I was like, oh yeah,
didn't
of
think
course.
about that. Yeah,
I didn't think about that.
Yeah. So and look, if it gets to a point at that time where something great has happened and they don't need it, then you've got an investment that can be used for wherever you want it to be used for. So that's one of the ways we can be a bit creative. And stuff like that. The other one is, look, as I said, make sure that you're not enabling. I've come to a stage in my life where we have to accept that when we're adults, we can have adult conversations. They're not simple and they're not easy, but sometimes you do have to sit your parents down and have an adult conversation and plan and let them know how you feel. Now, you still have the right to make your own decision, and you have the right to say no. That's tough, very tough, but you do have the right to say no in love. What does that look like? That looks like understanding whether you are enabling, whether you're actually giving, or do you know what I mean? And whether it's pulling out of you. Do it out of love, because there's no point saying yes and later on resenting them for it. That defeats the whole purpose. Now you can say yes and do a little. You come to that conclusion as to what's safe for you and your family.
Yeah, I think each time I speak to you, clearly now I need an annual meeting. Just like always planning for the future, and even if it means planning for those that you love, just putting those little steps or plans systems, into action from now. Yeah, just from now on, so that you don't feel the brunt of it in 10 years, 15, 20 years time, but actually just putting those little steps of like, okay, 45-year-old me is going to be so grateful that 20-year-old me or 30-year-old me took the decision.
Absolutely.
Right now.
And the children, and the own retirement. So everything, the future's coming, whether you like it or not.
Yeah.
It's whether you're ready for it.
It's like life is short, but life is very long. Life is
That's the
also
most
very
perfect.
long.
It is actually very long, but it's actually short. It comes by very quickly. And
Something else I want to talk about actually, which started to research after our first meeting, was creating a dividend account.
yes,
And I was like, this is so genius, so simple,
Yeah.
and so genius.
so what's a dividend? A dividend is, so when you invest in a business, right? When you buy a stock is a share in a business. You become a part owner of that business, right? Albeit a very small owner, but in theory, you are a part owner. And when you are a part owner, you have a claim on the profits of the business. Some businesses, when they generate profits, they have the option of reinvesting those profits back into the business. So there's that. So they don't pay a dividend. The other option is for them to distribute some of those profits to the shareholders. That distribution is what we call a dividend, right? The dividend is a distribution to the shareholders from the profits of the business. That's what a dividend simply is. And you can buy companies. Often the companies that pay dividends are quite mature. We say they are cash flowing businesses. They produce a lot of cash, and it is more efficient for the investor that these companies distribute the dividends to them rather than reinvesting in the business, because there's not that many opportunities to grow any further. So some of the most popular dividend paying companies are companies that are like, I'll give an example. Here in the UK, we've got Unilever, talking about things like beauty, or L'Oreal, right? These companies have been around for a very long time. They generate lots of cash. How much more can they grow? So yes, they do reinvest back into the business, but they distribute some of those profits to the investor. And if we're the investor, hey, we get a dividend. And often they pay these dividends. American companies, they pay on a quarterly basis most often. So every 3 months you will get a dividend. UK and Europe is often semi-annually, so twice a year. So that's what a dividend is.
I mean, I like the sound of getting paid quarterly. In my ideal world, my dividends would be millions every quarter.
And if you wanted to, if you didn't want to spend the money, you can reinvest those dividends back into the same business, so buy more shares, or you can buy shares in another company, and that will compound the dividends, because remember, dividends are paid per share. So when you buy more shares, you get more dividends next time. So this is how you can start a compounding machine in a portfolio, where you start small, you get a dividend, you might not spend it, you just reinvest it. And by the time you know it, your dividends are getting more. You do it for 5 years, 10 years, 15 years, 20 years. By the time you know it, wow, the dividends that are paying out can pay my whole mortgage, or can fund my lifestyle. That's how it can work.
That's the goal.
Alternatively, you might say, actually, I don't want to compound this portfolio. Maybe I've got a different portfolio for growth.
Yeah.
I want to spend out of this portfolio. Well, fair enough. You spend out of you eat the fruit, not the tree.
Yeah.
Right? The tree remains. Right? And it's still bearing fruit. You eat the fruit.
So that can be your enjoyment fund, as we spoke about earlier.
It could be your vibes fund if you
could
wanted
be
to.
Yeah, I like that.
The only caveat is it takes time to build a dividend portfolio that's actually quite meaningful.
Yeah.
Because dividends, I mean, on average, a good company might pay you 5%, 6% dividend, which doesn't seem like a lot.
Yeah.
But again, if you do it over a period of time, you should start seeing that compounding take place.
Okay, so that's going to be the goal. My enjoyment fund, my holiday fund, my We Outside fund.
Yeah.
My Nando's After Church fund.
It can be dividends. There's another asset class that I would say you can look at if you're trying to spend the money straight away, which is bonds, right? So bonds are different from shares.
Okay.
Shares are ownership, so I buy shares in your business. Bonds is a loan, so you can loan money to the business. Why is that option potentially even better for someone who's trying to spend out of their portfolio? Because you are living off the interest. Basically, that's what a loan is, right? You get the interest. And shares are more risky because you are owner. If that company goes bankrupt, you go bankrupt, right? Because you are owner. You're sharing the risk, which comes with reward. Remember earlier I said everything has two sides, which comes with its reward. So if the company does extremely well, then you do extremely well. So if, let's say we own shares in Nvidia or Microsoft years ago, we would have done very well. But if we just loaned £1,000 to Microsoft, they just have to pay back the loan.
Okay.
right?
Okay,
So you don't have that ownership,
Yeah.
right? You just, so, but if Microsoft was about to go bankrupt, for example, you would get paid your loan out first. So everything has two sides. So in terms of work, when we are creating portfolios for people that are, let's say, retired or really want to spend from their portfolio, chances are they will have a big allocation to bonds, and some dividends.
So before we go, maybe top 3 quick advice for what people can be doing right now to grow their wealth, grow their savings, grow their investments, all things financial.
I think in the current time, my best pieces of advice that I think works for a lot of people is to always think of your money in 3 buckets. And those buckets should be time frames, right? So short term, medium term, long term. Your short term is extremely important. It's here, it's right now. Make sure you've got liquidity, cash, ready to take off any short term needs. Medium term, if you're going to buy, like I said, if you're going to buy something in 2 to 3 years to 5 years max, then you should save it in cash or a very low risk investment. And don't forget your long term, because the biggest risk for our long term is inflation. The only way to beat inflation is to invest in assets that grow ahead of inflation. Stocks, shares, property, that kind of stuff. So always think about your money in those buckets and make sure you're taking care of each one of those buckets before neglecting the other. That's one. Is that one. Number 2 is, I'll go back to what I said earlier. If you are already an investor and you're investing, be very, very mindful of your emotions. I would say to you, 90% of investment success is managing your emotions, and less so picking the best stocks. Most of it, the reason why people lose money in the stock market is because they buy high when greed is at all-time highs, and then they sell low when fear is at all-time highs, because they're going off their emotion. Whereas we should be doing the complete opposite. You want to buy low and then sell high. So be very, very mindful of your emotions when you are making financial decisions, right? And specifically investment decisions. The way to combat that sometimes is to have systems in place. That's number 2. Number 3, going back to basics. Nobody likes the term budget, because historically when we hear budget, we think restriction. But a budget is not about restriction. A budget is just how you allocate resources effectively. So that's why businesses have budgets. That's why the economy and the government have a budget. That we just had a spring budget not long ago. So change the way you view budgeting and understand that it's a document just to tell your money where to go. And in the same breath, when it comes to money, sometimes you just change your language. Change your language. Don't say, I remember I went for dinner with someone and he said, what's the financial damage? I said, don't use that word. We're at dinner, we're eating good food. It's not damaging, right? Don't say, what's the financial damage? That's a negative tone. Use other words. So for me, I say things like, this is my cash reserve. This is my fund. This is my capital. Right? Money has many different terminologies.
Yeah.
When you give it the right terminology, you will use money better. That's number 3.
I like that. I love the last one because as we're saying about money and emotions go together.
Yes.
So I think even the words that you attach to spending money, as you're saying, like damage, it doesn't really have a great feeling to it. So already there's some part of you that feels like this is a loss,
Yes.
versus this is me investing into spending time with friends and family and those that I love.
Eating good food. Yeah,
Yeah,
food
and
was good.
enjoyment.
Yeah.
I love good food. I love that. Thank you so much for spending the evening with me and
No, my
just
pleasure.
sharing all your knowledge. And thank you so much for joining me on this episode. Make sure that you follow Jacques on his socials. I will link all his info down below. And obviously follow me as well. Subscribe, like, comment, share it with a friend. The friend that you know needs to hear all this financial advice, your mom, your uncle, and anybody else that you love. If you love them, share this video with them. And I will see you on the next episode. Bye-bye.